Welcome to the Real Vision half-day briefing. It's Red Friday, November 26, 2021, just after market close. I'm Ash Bennington. I'm Weston Nakamura. I'll be joined shortly today by Craig Peterson of Tier 1 Alpha. But first, let's just take a look at the markets from today. Maybe let's not. Maybe let's just call it a day. Yeah, let's call it a day. There's no daily briefing. There's a half day in markets, day after Thanksgiving. I'm going to be talking to Craig Peterson, as I mentioned a moment ago, specifically about the U.S. equity market and what I believe and what he also believes is driving the equity markets. It is, to an extent, fine. It is this like South African variant of COVID, but it's also kind of a mechanical structural thing. It's basically gamma activity, and which we'll explain as well. But Craig has some great tools that he has available for anyone to use for free. He's developed them himself. I use them personally. All right, Craig Peterson, Tier 1 Alpha founder, CEO. How are you, sir?
Doing great, Weston. Thanks for having me on.
Yeah, happy belated Thanksgiving.
Yeah, you too.
So Tier 1 Alpha. So I've been using Tier 1 Alpha for, wow, I guess, you know what? It's probably not as long as I think because it's become such an integral sort of thing that I take for granted now. But a couple months or so. So this is something that you've been developing on your own. You are a trader. You are a coder. You are, and then you on your free time, you also like to defend the country and you like to fight fires. Um,
Yeah, that kind of sums it up.
yeah. So no, but so Tier 1 Alpha, you this is basically your creation. It is a suite of tools that is never kind of ending as far as I'm concerned in terms of what new tools you keep adding. But the two key ones that I want to focus on are your MBAD indicator, MBAD, which stands for
Market breadth advanced decline.
for kind of a sector view, as well as gamma indicator.
Sure. We also have just our gamma exposure models,
Okay,
which
so why don't you? So instead of me butchering what you do, why don't you, like a normal human being, let us know what it is that your company does.
yeah. So we create tools that kind of help you see what's happening in the underlying market structure, rather than just some narrative or some technical analysis. So specifically with the MBAT indicator. The problem with looking at spot price a lot of the time is these indexes are calculated using market weighting, right? So the bigger the company, the bigger the market cap, the more influence they have on the markets, which is great for some circumstances, but it's actually terrible for a lot of other ones. Um, there's plenty of days where you can see mega cap stocks, you know, all down, they're all in the red, yet there's still 60-70% of the index in the green that day. So what that kind of tells me is it's a bad day to be passive, but it's a good day to be an active trader, if that makes sense.
Um, Depends on what you're actively trading, but
Sure.
it
And
means
in the
it's
grand
a good
scheme
day
of
to.
things,
What you're saying is that it's a good day to be the job of single stock picking, if done correctly, will you should be rewarded if you have done your job correctly, as opposed to if you've done your job and it doesn't even matter if you've done your job great or not, because the index is controlling everything from top down. Is
right?
that
I mean, spot price is just it's just so distorted that it's not really a good it's a single data point trying to sum up what 505 tickers are doing that day. And a lot of times it's really disagreeing with what the actual underlying market structure is doing.
right? So I'm looking at the 1 day. So if people just go to tier1alpha.com, they can just basically check this out and use it immediately for free.
For free. Yeah. We have no paywalls up right now. So our market breadth tools and our gamma exposure models are all free and updated daily. Our MBAT indicator is actually updated about every 25 seconds or so. And then we have a live spot price on top of our gamma models.
Fantastic. So today it looks like we have 472 stocks down in the red. So 92% of stocks down and 38 that are up. And I'm guessing those are like the healthcare ones, the Modernas, whatever.
Correct. Netflix actually made that list today, which was interesting.
Yeah, because that's a quote unquote stay at home stock.
Right.
And this is where I would say like this time is this time is different, obviously, in the sense that we now are conditioned. We already know what the COVID positive stocks are and the COVID negative stocks and all that, and so we're just replaying that again. So that's why like this story actually does become a self-fulfilling narrative, self-fulfilling prophecy. But again, at the single stock level, maybe at the industry level or the sector level, not at the index as a whole level though, because not everybody. If LVS falls, fine, but people selling the Nikkei, the Hang Seng, Eurostox, DAX, SPX, and the Russell all down like because of COVID. That's not the case. So I'm seeing that, yeah. So there's basically every stock is massively down, except for a handful. I'm assuming that South Africa having a powerful variant of COVID does not equal every single stock and company in the S&P 500 being equally hit negatively on a fundamental perspective, if at all. Be it if you're Visa or Johnson and Johnson, if you're like Accenture, whatever the hell it is. None of those are all completely different businesses. Coca-Cola, yet all of them got hit down today. So why did that happen? Because that happened at the index level, right? So that's what that's what this basically tells me, right? When I see this distribution that is massively skewed this way, and then it looks like if I look at the fangs, they're kind of lined up in the middle there. Tell me what's going on with that.
So again, with market cap weighting, spot price is not really a good measure of it. And today actually could be one of those rare days that it is a good measure of it because so much of the index is sold off. Like you said, about 92% of the S&P 500 is sold off into the green today or into the red today, which tells me, this is a very serious sell-off. Basically, everything was sold off. It wasn't a few major mega cap companies that had a bad day. Everything had a bad day.
So people sold their single stock holdings as well as their SPY. Is that what you're saying?
I mean, it wasn't just SPY. People were literally selling everything they had.
That's what I'm saying. So
And,
people sold their single stock holdings as well as their SPY, but mostly they were actively selling their single stock holdings.
right. I mean,
Yeah.
92% of the index in the red. I would say so.
Yeah. Um, Now, how do you how does one determine how much of that is from a top-down passive product that is actually indiscriminately selling everything versus dispersed investors who collectively own everything and are also individually selling everything, but as a collective whole, that turns into a selling of everything. If you know what I mean?
Yeah, I mean that's a very long conversation to have, to be honest with you.
Yeah, yeah.
There's a lot of things at play. It's just the passive nature of the markets. Selling indiscriminately
Right.
within the indexes. There's also these delta hedging activities going on for every option that's sold. These option makers are hedging their positions by buying the underlying. And then the third part of that is volatility controlled strategies, which use realized volatility as a trigger to either de-risk their portfolios as realized volatility spikes or add exposure to risky assets like equities when realized volatility is falling. So it's really those three major market dynamics that drive most of the behavior that we're seeing both intraday and on the longer term.
And do you mean for days like today, or do you mean any day? Or
Well, again, it's quite the conversation to have, right? The intraday movements a lot of times I think can be explained by these underlying market dynamics, but yeah, that's a vast conversation to have. That honestly is it's a lot of new territory that hasn't been thoroughly researched yet. So
fair enough. So okay, so embed indicator is great for just getting a snapshot into what is not what is going to happen. It's not like a predicting tool or anything like that. It is telling you what is happening under the hood of just SPX. If you look at just that, it doesn't tell you what's actually happening. It can mean any number of things. SPX being down minus, 0.5%. What does that mean? That could mean any number of things. This actually gives you, a deeper dive under the hood. So it was a very useful indicator. But I want to talk about this gamma exposure. I guess what's going on here. I'm looking at it from the gamma exposure. And let's see, you have this green shaded area, this red shaded area, positive, negative, gamma, red line, green line. I guess if you could explain what those are.
Sure. So this is our gamma curve chart, and essentially what it's showing is how much notional index pricing is at risk at those certain strike levels. So essentially what's happening with gamma exposure and why it has such high influence on the markets is when you go and buy a call or put option, you're buying those from a market maker. And that market maker isn't going to take on the same directional risk as you. They're going to hedge their positions by buying the underlying stock. So on a very high level here, when option dealers as a whole are long gamma, that means that they're going to be buying into the dips and they're going to be selling into the rallies, which kind of it suppresses volatility, and you get these lower volatility regimes, which can slowly move up the markets, and it's also crushing realized volatility.
And the reason that they do this is because market makers are legally not supposed to have any directional position. They are not supposed to take a directional position. This is due to regulation, all that kind of thing. They don't take bets. They wait for traders to come in and say, hey, I want to buy a call option. Then they say, okay, I will sell you a call option. When they are short a call option, then they have exposure that they need to essentially balance out. They don't go out and buy a call option per se. They will do that by just buying the underlying, be it futures, stock, or whatever it is. And then as that underlying moves away from, or especially towards, that kind of strike price of the option, especially as it gets closer to expiry, then gamma kind of goes crazy, and it really kind of makes the underlying market go crazy because of this activity that's constantly churning on, like in the background, right? What you're saying, Craig, is that activity itself dampens volatility because it basically sells into softer rallies of the softer upward drifts, and buys into the softer downward, moves and falls. Softer because probably of them making them sort of softer to either side. But then what happens on these flips? What happens then?
Well, it's all about staying delta neutral, right? And when spot is at different levels, you have to do different things to keep those delta neutral positions. So when spot price flips into negative gamma territory, to stay delta neutral, they need to sell that underlying stock because they suddenly have too much risk on their books. So what they end up doing is selling into the dips, which creates these really crashy environments, both to the downside and to the upside, which is why you see, these will have a 2-3% down day, and then suddenly the markets will come back up 3-4%. That's really due to these dealer hedging activities going on.
And when you see that flip, what does that mean? Is that why does that happen? Is it because of an expiration, or is it because it hits a certain level, or?
It's because it hits a certain level, and the hedges that they do have are either too risky, or they need to buy more hedges.
There comes a point where there comes a specific, sometimes you can pinpoint down to a specific level, like a certain level on the index, where there's a ton of market makers and market participants that have a lot of exposure and open interest, and that point is kind of like it could act as sort of a resistance or a support or resistance level, and so you could kind of see where the market might bottom. But if it does actually go through that, it's gonna really go through that, right? Is that more or less what we're kind of talking about in terms of like a layman's?
Correct. Yeah, I mean, if you look at the gamma exposure by strike from the options chain, and actually on our website we have a chart that shows the put call gamma by strike, and what it highlights is levels of importance, right? So is it support? Is it resistance? That's that gets a little more complicated to say, and honestly, a lot of the times we don't know until after the fact. What I can tell you about these levels though is they act like a vacuum for spot price. And you can tell that those are going to be highlighted areas. A lot of trading is going to be happening around those areas.
So, if it stays within those areas, and this is why, by the way, too, would you say that this is why, like, the S&P will just kind of grind, like, softly higher day after day after day by, 0.4%, 0.5%, by, like, it's just kind of in this almost trapped within this bubble, like this like what's that movie, Biodome? It's like that, kind of like that, where it's just like stuck in this like environment of these levels where there's a lot of open interest, and that's where most of the activity or lack thereof kind of exists.
This is kind of the other big market dynamic that a lot of people don't touch on, is when we do get stuck into these ranges, realized volatility for the S&P 500 drops, and that's going to be triggering these volatility controlled strategies, whether it be like a target date retirement fund, risk parity, certain VTS annuities for insurance companies. There's over $1 trillion worth of assets in here of flows at play based on realized volatility. So when realized volatility drops, these funds end up adding exposure, which gives you this really slow crawl upwards for the markets. And then, it's the old saying, the markets take the stairs up and the elevators down. And that's basically the underlying factor that's happening there.
Right. And so a lot of times people often like give me a lot of shit for as if I'm just kind of out of my mind, which I am, and that's legitimate, but not about this one. But yeah, but I will say that sometimes I'll say, like, there are often times where this is not the tail wagging the dog, where when volatility is controlling the underlying, when like options control or options are dictating the price movements of the underlying, and that is not only happening, but that's not a tail wagging the dog situation. The options are the dog, like there's much more notional, there's much more activity happening. That is where the action is taking place. That is the sort of the patient zero, if you will. And I have a chart too of I forgot, like, I think it was S&P Global Research put something out, but of March 2020. And they show, like, insurance companies, as you were just saying, life insurance companies, and their ETF activity. Look, these are long-only asset managers. These are not traders. This is like a long-only asset, like MetLife or type of things that hold SPY or whatever it is, like some sort of index ETF. And then once the VIX goes through 20 specifically, then the ETF activity spikes through the roof, and that's when, because that's when all the systematic, risk control systems kick in. This is not people that are doing this. This is all very much programmed. Like, if the VIX hits 20, we will sell 300 billion worth of equities down, like, at market, like that, which triggers more of that and triggers more and more and more. This is not a conspiracy. This actually happens, right? This is actually how things are set up.
Exactly.
Right. And it's done that way to keep human beings' trader emotions out of the picture. It's a stop loss, essentially, is what it is. But instead of having an index level, they're looking at it on a volatility level. So that's why there are specific levels of volatility where if the VIX hits this, S&P will go nuts. And that's why I would say that the VIX index is just an index, but that absolutely does drive the underlying S&P index in certain scenarios, especially these very quick sort of crashy things, right? So regarding today, we saw pretty significant move in global indices on decent volume, especially given the fact that it's the half day after Thanksgiving. Would you say that did we see a gamma flip today, or are we about to see one, or what's going on there?
So going back to Wednesday before the holiday here, we actually bounced off that zero gamma level, and it acted as a place of support for that day. And then I think we closed back in at around 4,700. So we did already play with that level. And this is post OPEX, which was just last week, which means a lot of those initial, well, not initial, but a lot of those existing hedges that dealers were playing around are suddenly gone, right? They've either rolled over, they've expired, worthless, and new positions are now coming in and kind of taking over those levels. So we bounced right off the zero gamma level last week already. We already knew that that level was in range of spot. And then obviously Thursday markets were closed, and then futures last night around, I'm on the West Coast, so I think it was around potentially 5:30, 6 o'clock West Coast. Futures really started to heat up and get a little pukey, right? It started to get a little crashy.
Yeah, it's called Japan Cash Open.
Fair enough. Okay. Yeah.
Yep. I was watching that too. Yep.
Yeah. So I mean, but we knew zero gamma was in play. We knew spot was willing to go there already. And then watching the futures open, it tanked way past that level. So we had a pretty good feeling last night that the markets were going to open at a very crashy level today. So we are sitting at negative gamma right now, 4,600. The gamma flip is at 46.67 for SPX.
Okay, so that's this green and red line, the dotted line on the gamma exposure just on your tool. What are those respectively? Spot and...
So the green line is spot price, and the red line is the gamma flip.
So that was so the green had already crossed below that
at cash open this morning. Yeah.
At cash open this morning, and that just triggered this kind of indiscriminate avalanche of selling from the systematic community, which then triggers other retail traders, whoever it may be, which then triggers systematics again in kind of a feedback loop. Is that
if you wanna sum this up into a whole story? I think regardless of narratives, I think the macro catalyst for the day was this new COVID variant in South Africa, and that kind of chose the market direction of the day. Regardless of whether there's any merit behind it or not, it was a narrative that people were paying attention to. So once the market chose a direction to be heading into, it hit the zero gamma level, broke past it, and then that started these market makers having to sell their underlyings because they no longer need to be holding so much long stocks because the market's been going down.
Okay, so then let me ask you then, when you say market makers as well, are these human beings?
These are algorithms. There might be a lot of people that took yesterday off, and there might be a lot of Series 7s at home with their families today. But at the end of the day, these algorithms running on these servers are 24/7. They never go away.
So then it doesn't really matter that it's Thanksgiving or not.
It doesn't really matter if it's Thanksgiving or not. These algorithms are running, they're working, and they're ready to go.
Does it matter that the Thanksgiving people were absent from markets?
I don't think it matters at all. If there was not a single person sitting at their desk today, I think this market still had a really high chance of acting like it did today. Again, we kind of need that macro catalyst. We kind of need some sort of news to have the market choose which direction it's going to be heading. But once we get past a certain point of that, all these other underlying market structures kind of take a hold in, and they are really driving the price action. So over the past few weeks, we've seen volatility trending up with spot price. And what has been typically a pretty decent signal in the past has been the 11-day correlation between the VIX and spot SPX. And we actually saw that trigger 2 times, roll into positive territory and then break down to negative territory again, which has created these pretty memorable signals in the past. So we recently just saw that. And essentially what this is telling me is that there is some unpriced fear in SPX. People are worried. They're buying puts. They're spiking the VIX, but at the same time, it's not being reflected in spot price of SPY. So I think that was kind of the first sign that people are starting to get a little bit nervous with markets.
When you say spot up VIX, spot up vol up, every time I hear that, my immediate thing goes to February 2020 and February 2018, or January 2018. You have spot up, VIX up, and then shit hits the fan.
Shit hits the fan. There's fear that's not being priced into the markets. That's essentially what it's
not being priced into the underlying index.
Correct.
But it's certainly being priced into the volatility markets.
Correct.
Yeah. Oh, and when that happens, do you ever you look at skew and stuff like that?
Sure. Yeah, we do. We do look at skew, and actually, the other one that we like to watch is a Volleyball to Vix ratio. And typically, when this is low, it's signaling that there's a lot of fear in the markets, and you typically see these sell-offs. When it's higher up, there's more complacency in the market. So what's interesting about Volleyball and Vix ratio is it actually tracks the skew index pretty closely here. So
that makes sense.
Yeah, this one isn't quite updated here, but
that makes sense though, because that's the volatility of volatility is increasing relative to volatility itself. Implied volatility itself.
So you can see it's actually going up today, which is more I would call that uncommon versus the trend here, because they do tend to trend together.
That's a great explanation for what happened, what actually happened in markets. Not narrative. This is actually what the buys and sells are happening. So where do we go from here? I guess how would you assess the markets? Not specifically a direction, just generally that gamma flips from positive to negative. What do you do? Are you looking for the immediate kind of turnaround?
So negative gamma volatility, or rather the volatility that comes from negative gamma, to be a little bit more specific. It's not just downside risk. There's also major swings to the upside, because these option dealers, these market makers, they need to sell into the dips, but as spot price comes back up, they need to buy into those rallies. So as spot price is in this negative gamma land, you can just expect higher volatilities or higher volatility going in both directions. And again, kind of to push this point here, what that does is it drives up realized volatility from the S&P 500. And after that happens, back to these volatility control strategies, they start to de-risk, because if the market goes up 4% and down 4%, realized volatility doesn't care about the direction. They just say, hey, this is a volatile market. Yeah. So either way, you're going to be getting those downward pressure flows. As far as where the market's going, I will tell you, volatility is probably here to stay. We have a couple more weeks till the next option expiration. To me, it looks like a lot of people have picked their bet now, and those levels are going to be pretty key. So if we're going to be looking at an end of year rally, obviously it could happen. There's no crystal ball here, but I would look at the next 3 weeks, 4 weeks. I would expect some higher volatility. I don't think this is just going to go away.
Yeah, I absolutely agree. Into December expiry, which is a quarterly, I think that things are going to be, things are going to be volatile. Now, volatility, again, just as Craig said, does not mean downside. There is upside volatility. Volatility just simply means that there's a huge range of swings that happen. And the upside swings are not any more pleasant either than the downside. I guess the downside would be a little bit less, but the upside swings are not like, people aren't really cheering those either, because people are either gonna think, oh, like, oh, I'm missing out, they're chasing, and so it's a different kind of like this distress, but like and that just leaves for a very kind of bitter market sentiment or nervous market sentiment when things are happening to the upside and to the downside. And then so I think that December expiry is a massive like date to mark on your calendar, and seems like you agree as well. So from now, now that we've had this sort of day, if we start seeing options open interest for that December expiry are starting to increase going into December versus closing out of positions into December. What's, I guess, the difference between that scenario A and B upon expiry and thereafter? Like,
I guess it depends where the open interest is, right? And that's kind of giving you a hint at where the bias is from the market. So if we see a bunch of put open interest start to kick up, well, that kind of tells you something.
yeah, and then I guess my question was, the setup was what happens with when expiration passes and things disappear, this roll off effect. What does that mean?
Looking 3 weeks into the future, or however far out we are from that quad witching day.
A long time.
Say, man, what can happen?
Yeah. Well, then let's take a look back. What happened in March 2020 after expiry?
After expiry, I think the Fed kicked in with QE infinity essentially for the rest of 2020 at least.
Yep.
And a lot of those positions that were being hedged got rolled over and washed out. So it just kind of opened up new levels for people to be interested in, which created this upside bias.
But it made existing positions disappear.
Correct.
Right? Yeah. And so that's what I mean, the flush out. Once those disappear, that's significant, because up until then, what just disappeared had been the leading driver of the index, and that has now disappeared. Which means that it doesn't necessarily mean that things are going to flip. It just means that the main driver has vanished, and Correct. It's kind of a blank slate almost. And it can still continue that direction, but it would be a new monster, tag teaming in. But that original thing is gone now. However somebody wants to take that, they could take that however they want to. But it is significant to note that a key driver has been gone.
I like to think of OPEX. It's the not so secret anymore, right? It used to be the thing that people were like, oh, what's OPEX? And they weren't quite sure how it interacted with the markets. And now you're seeing OPEX states kind of get front run by a few days here and there. But I think a lot of people, I think, okay, this edge is going to get washed out. This edge isn't going to matter anymore, just because it's going to happen. Which in an efficient market, yeah, I mean that's typically how it should play out, right? But the point that I think a lot of people are missing are these positions have to happen legally, right? I mean, these hedging these neutral positions have to happen. So whether you know about it or not doesn't change the fact that it's going to happen. If that makes sense.
Absolutely. But I also will say that the majority of market participants are not aware of this activity at all. They simply aren't. I would submit that a lot of people who are going to watch this are not really familiar, which is why they should go to Tier 1 Alpha and find out, at least get some baseline view of what's going on.
So it's kind of an interesting thing, because this stuff is very complex. Options to begin with are very complex. And a lot of times I don't know if people are so much interested necessarily in the academic side of what's happening. They just want to know what the trade is, right? And knowing how to use something and knowing why it is are two very different things. I doubt most people understand why their iPhone works and why it's connected to these 5G networks. There's probably very little understanding on how those dynamics actually work, but everybody knows how to use their iPhone, right? So that we are coming out with an educational series on exactly what's happening, trying to explain it very simply. But at the end of the day, if you can understand how to trade it, then you're going to end up with an edge.
Yeah, that's a really good point too. It's basically like, these are tools. These are not, like predicting markets or anything like that. nor would you want that, right? Like you're gonna what? You're gonna go to Craig every day and be like, "Hey, where am I buying and selling today?" No, like that's not like what you. That's this is like a very much a teach a man to fish versus catch a man to fish sort of scenario.
Absolutely.
Yeah. But you're providing a fishing rod, and without that, you would not be able to fish at all. So I think that
Lake, I should say too,
what's
because I
that?
mean these levels really show you exactly where this activity is going to be taking place.
Say that again.
Oh, it's also like a fully stocked lake. There's plenty of fish to be caught.
Oh yeah, yeah, absolutely. Yeah, I mean the fact that like options activity has not just exploded, but it's exploded in very weird ways, such that the institutional community is also very confused as to what's going on. I think that the what Robinhood and all that has done is like it has democratized finance, but not in the way that they're talking about it. It has done it in a way that it has leveled the playing field of cluelessness across the board from institutional to retail. So now nobody knows what's going on. Institutional has no idea what the hell is going on with who would buy a 300 vol asset? Well, these people will. Like like they're working on these assumptions. They don't see the flows and all that, and they are huge predominant part of the flows on a lot of days. And then obviously individuals don't know what's going on in the institutional community. So it has leveled the playing field where it's become kind of a every nobody really has that edge. Of course there's some do and some don't, but like by and large that edge has been filed down, I think, like it to
Options went
unprecedented
from
level.
right. Options went from these tools that were meant to give people hedging exposure basically, and then they turned into a directional bet. And I think that's been the biggest shift. It's a directional bet on the markets with a high payout and a limited risk. You're only at risk for what you put into it, for making a directional bet. And I think that's kind of been the big shift here too. Is it went from a hedging instrument to suddenly now spinning the roulette wheel a little bit.
I would actually look at it. I would put a different iteration on it. I would say that it went from a hedging tool, a legitimate hedging tool. Not say speculation is not legitimate, but it went from a hedging tool to a speculative tool, but as a kind of a small part of your portfolio, like it's like your Vegas gambling budget, if you will. It went from, but not your core like activity. What I'm gonna add on to that is that then morphed into became a core part of activity for people have 90% of their liquid capital that they have in the markets in listed derivatives. So that is as opposed to sub 5% or something like that. That is a huge shift. The how much not just notional value in aggregate, but how much percentage of individuals' portfolios and therefore their attention and their emotions and all that are tied into options activity. That I think is even more significant than switching from hedging to speculation.
Sure, no, that's a great point. I mean, that's kind of the next level where we are today, post this Wall Street phenomenon of just going all in on something that really doesn't make sense from a fundamental aspect.
Craig, thank you so much for this because if I said all this, nobody would believe me. So you bring credibility to the table.
Oh man, well, I hope I can bring some credibility to it.
Well, the
Putting that together.
bar's on the floor, so and if you brought like a sliver of it, that's 100% more slivers than I had. So anything anything helps. But my point is that don't be proud about what you brought. Don't be proud that you made a difference here. You can only make a difference here. But so yeah, so just I guess let people know where they can find you.
Sure. First thing I want to mention is everything right now on our website is completely free. Gamma exposure data, especially, is typically pretty expensive, $50, $100, even upwards of like $300 to get this data. we're offering it for SPX for free right now.
I'm sorry. I have to interrupt you. On the institutional side, it is millions of dollars of commissions that you have to pay to the brokers and all that. So, but it's
on the retail side of things, and there's honestly just not a lot of places that you can even get this information. But if you guys want to check this out and check out our market breadth tools, especially the MBAD, you can go to t1alpha.com. And like I said, you do have to sign up because for some of our tools, you can save custom portfolios and watch lists. So that's the reason we have a sign up right now. But it's all free, free to use, updated daily, very upkept. And we have a whole lineup of tools under development right now. And keep an eye out. Just about every month or two, we're going to come out with a new page, a new tool.
And I'm going to leave the link in the description of this YouTube. But Craig, you also you put up like very interesting charts like on Twitter. A lot of it is not tier 1 alpha product related. It's kind of the stuff that you just do on your own. But I guess my point is that people should be following you on Twitter as well. How do they do that?
Sure, our handle on Twitter is T1 Alpha, and yeah, I post up anything I see interesting throughout the day, and a lot of it's actually sneak previews of products that are going to be available on the website. As soon as we get to that queue. And on top of that, I'm a trader too. I mean, my whole team, we're all traders first and foremost. So we build tools that we use ourselves, which is why I think it translates over to give the people what they want, because we're the people too.
You think that I would be talking to you if you didn't have skin in the Craig is a extremely nice and humble person. He crushes it in markets. He embarrasses institutions embarrass themselves. So again, that's a low bar. But Craig does very, very well. I specifically have him on for this very reason. I don't know I don't know how to classify him. He's either a brilliant coder, a brilliant trader, or one or the other. I have zero idea how to do one, and I get sometimes lucky on the other, and you could probably figure out which is which. but yeah, no, I've grown dependent on Craig's stuff, and so I want to bring him on so that everyone else could kind of at least see what he is giving away. So I, for one, am very thankful. Thank you for explaining it. If you can too, like, I'd like to kind of get you on just to go over what's going on, like actually happening in markets. To forget the narratives and all that. Let's just talk about what's actually moving prices periodically, or we could do it when you have a Red Friday. What's that? What's more interesting?
Oh, down days are always more interesting. Big red days like today.
Why is that?
It's just when you see the action, man. Like kind of like I mentioned earlier, we see stocks take the elevator or the stairs up, the elevator down, and it's more interesting all the way around.
It's more interesting because, well, we've seen upside every day.
Fair enough, right? Yeah. Mm. So if you're long and you're making money on those days, potentially you get some more comfort out of it. But if you're a finance nerd like you and me, a little bit of drama now and then keeps it interesting.
And I'll also add, Craig is also a very knowledgeable crypto involved person as well. So I just want to. He's not like a boomer stock guy only. He's got his hands and everything. I guess is there an asset class that you are weak in, I guess, or don't really know much about?
Oh, potentially a big one. I checked the dollar, but as far as FX goes, that's part of the reason for this is one of my partners for T1 Alpha. He's been a career FX trader for a family office. So I always kind of lean on him for that space, and it's not something that I track all the time.
Okay. So are you basically saying that you don't need to look at FX in order to do well?
I'm saying that I have somebody else who looks at it for me.
Okay.
It's obviously very, very important. But
so
as far as my focus and my research, it's typically, equities, crypto, options. That's kind of my thing. Unfortunately, there's just not enough hours in the day to do it all.
Of course, but as and we probably should have started this, but just tell people what your background is or what your background is not, which is you're not coming from Goldman or anything like that, right?
Correct. For better or worse, I guess it kind of depends on the person, but I have no institutional background. This has just been me digging in, managing my own money for years and years, and I got really tired of losing money early on. That's really what drove all of this interest.
Yeah. So that probably is the most important thing. One of the most important, kind of reasons that I want to bring you on to is that I just want to like show people like, look, finance is overwhelming, or it can be overwhelming. It's a lot of stuff. It's never not going to be overwhelming. You're never going to be at the I've learned finance now. I'm done. No, it's every day we all start off at level playing field. We have no idea what's going to happen by the end of the day. Craig, myself, like we are. Yes, I have an institutional background, but I've done far more learning on my own than not, and we really do our learning via having skin in the game in markets. You don't learn on an institutional trading desk because it's not your money. You learn from losing your own money and making your own money, right? So Craig is not at a disadvantage. He's at a massive advantage because of his lack of institutional experience, yet somehow putting out institutional grade product. So again, much respect to you. Don't wait for me. If you have something that you see in markets, just let us know, and we'll get you back on here.
Yeah, sounds good. Absolutely. Thanks for having me, Weston. Appreciate it.
No problem.